What a day it's turned out to be. Hello and welcome to this special edition. We're calling it the big sell-off and couldn't have named it any further or any differently, I should say. You're watching the next half an hour with me, Aisha Faridi, as well as Nikunj Dalmia. When we came into trade, the headlines, Nikunj, were crude at 85 and you had the Rupee as well, which opened starkly lower, a fresh record low coming in for the Rupee. And then the news flow and the churn. What with ICICI Bank, the fact that Chanda Kocher's request for an early retirement got accepted, which is why I guess the stock went the way it did. But just the market fall and then the news on an excise duty cut to the tune of about 5 rupees per litre on both petrol and diesel, and the fact that OMCs are going to take a hit of 1 rupee as well, that has really shaken off the market. It's a sub 10,600 close.
That news came in the dying hours of it, but the fabric of the market in a sense had got destroyed way before that. And you can blame it on crude, you could blame it on the weakening in rupees, simple macro concerns, or pure vanilla compulsions by institutional investors and by retail investors and by Chennai investors to get out. You've reached a level in the market where you don't want to sell because prices are not high, but you are forced to sell because you have no other alternative. Either you're running out of cash at a broker level, at the fund level, or at your in your trading book. So compulsions were at play. The buyers currently are absent. We can use words like rout, we can use words like decline, crash, whatever may be the whatever may be the choice of word. The underlying message here is that markets are going through a painful grind. But good news and good prices, they rarely come together, is the point I want to make right now. Volatility has just gone higher. Market valuations have come back to a level where they could be called as reasonable, no longer expensive. By every major parameter which we track, whether it is forward P multiple or price to book for banks or the way earnings projections are likely to move in, there is going to be a big shakeout, but is that shakeout in the price? So my sense is that we are going through that process where right now there is compulsions which is at play, and if you really want to make money in stock market, like Buffett says, buy the fear and sell the greed. Greed is missing, fear is an understatement. There is a rout and Armageddon in the financial market.
Yeah, that really seems to be the case. In fact, at this point, I also want to take in the ET small case greed and fear index, because I think this index of ours, which is a proprietary, index reflective of the mood in the market, has really been the right and apt gauge. Has been an extreme fear zone for the many days, and my sense is that this index, the needle would have been much, much lower today and would have been at the starting point of that extreme fear zone, or rather I should say in that extreme end of the extreme fear zone as well. Because when we came into trade today, the index was at a reading of 13 odd, and by the close of trade, it's gone into single digits really. So we are at the other end of the curve when it comes to the market sentiment, and that's what the ET small case greed and fear index gauge as well is hinting at. In fact, before we bring in our experts to analyze really what's going on with the market, what is it that you should be doing, I'm going to bring on board our researchers Ajay and Pankaj to take a 360-degree view of what's really going on in the market. And Ajay, to you first, what do you think are the factors which are leading to the sell-off? I mean, what is the dealing room pulse like? What are dealers saying about where is this fall going to get arrested, and should you really be looking at buying and catching this falling knife?
Well, the last hour of trade today really broke the back of the market when the finance ministry came out and announced that oil marketing companies would be sharing a rupee a litre kind of extra burden in order to ensure that consumers actually are eased off some of the price burden in fuel, both petrol and diesel. That gave an impression to the market that perhaps the government is now being forced in a corner to roll back some of the reforms like deregulation, etc. That broke the sentiment in the market. As it is, the market was grappling with slowdown concerns, rate hike by RBI and toning down of growth, scaling back of earning estimates, not to mention global scenario is not very healthy, yields are high, crude oil prices are high. So that was the kind of setup market was working in, and actually saw large cap meltdown in happening. Reliance, TCS, multi-year breakdowns in today's session. So all these factors put together really broke the back of the market and took the Nifty below the 200-day moving average today.
All right, I'm going to just introduce our guest panel now. Jonathan Sishal, Rakesh Arora, Krishna Kumar Karwa, they three joined us, and they'll walk us through in the next 20 minutes as to what is the way forward for markets, both from an institutional side, from an sell side, and also from the FI side. Jonathan, the view which we have in India is foreign investors are feeling the heat of emerging market meltdown, and because their gains have got erased because of a decline in currency, more than levels, there is forced selling and redemptions which are forcing foreign institutional investors to reduce their positions. At your end, what is the update?
Yeah, I mean, clearly, I think domestic investors who live in rupees, the indices have been, the equity indices at least, have been pushing up nicely and everything seemed to be hunky-dory. The reality is for outside investors, foreign investors, when we've been looking at India in dollar terms, then the situation has been a little bit more difficult. Obviously, it's been quite negative because of the rupee falling. So effectively, the adjustment that a lot of emerging markets have been going through up to this point, India had only adjusted via the currency. The equity markets were still very buoyant. I think what we've seen now is clearly a very nasty correction, really, since the whole, the end of last month. You can call it the ILFS issue or the Yes Bank issue, more activist RBI, or even, to our minds, perhaps more importantly, what's been happening in crude oil prices. So what's happened basically when you look at today's move, for example, it's the big index heavyweights that have led this and held this market up year to date. They're finally beginning to get crushed. Whereas other investors, us, for example, where we've been a bit more broad and invested around the entire market, it's already been a pretty difficult year so far. So actually, the more recent sell-off that we've seen, I think is actually reasonably healthy.
Mr. Karwa, we're already at a 4-month low. Do you see that the pain points are in the price? Or do you sense from these levels as well, around 10,600, there still could be significant pain left in the system and the poison is not going to be out anytime soon?
So if you look at various segments of the market, I think as far as the small mid-cap segment of the market is concerned, the indices over there are almost at 2-year lows. So there I believe that most of the pain has been done with. I don't know how much buying support will come in the immediate future, but there I believe that a lot of pain has already been taken. As far as the large cap indexes are concerned, and as the other gentleman also said, there could be still more pressure because there were some 5-7 heavyweights which had kept the index at a very high level in the month of August, and now they seem to be under pressure. So there could be more pressure if the markets have to go down. Then it could be specifically to the large cap indices. The broad market would possibly hold. That's the sense that I get. So all said and done, for the last few months, whenever we have seen corrections, we have seen that the indices the large cap index has held at around 10,800, 10,900 odd levels. But today's move has decisively broken those levels. I am not a technical analyst, but we do keep a track of broad important levels. And today the sentiment was really bad. And at the end of the day, the government has come out with these good measures as far as price relief on petrol, etc. But so that should be possibly taken as positive going forward. And in terms of maintaining the fiscal also, and also the state governments have also started coming in and giving the price relief. But the sentiment that as far as the oil marketing companies, I think they're taking some part of the hit. I think that has again impacted sentiment. So net, I think the large cap indices are more vulnerable today than the small cap, mid cap indices, is the sense that we have.
So KK, my next question is that how does one judge this is the time to buy or this is the time to still conserve cash? What has got bad could get worse, terrible could become horrible. How does one judge that this is a time to buy fear or this is a time to avoid buying a falling knife?
I think today is the time not to analyze the corporate balance sheet, but to be analyzing your own individual balance sheet, how much risk appetite that you have. And that will be the deciding factor as far as whether you start nibbling in now, or you wait for more clarity. So I think it all boils down to it, whether to invest directly or through the mutual funds or PMSs, etc. I think the best thing to understand is, as far as individual investors is concerned, is your risk appetite. But as far as institutional investors are concerned, I think they have been very focused in terms of not adding any new stocks to their portfolios in terms of the mid cap and small cap segment. And domestic mutual fund investors have been very value conscious, and I think for them it's a question of the flows, how the flows maintain in terms of the inflows. And we have seen in the month of September that the flows have been again tapering versus August or July. So I think that will determine the ability to invest. But we have seen that whenever there is, whenever the pendulum swings either way to extremes, you need to act. I think probably in the next few months you will see that the way the markets are behaving, that we are more going into kind of a bearish territory, etc. But the future is bright, and you should be looking to invest.
And the next question, Krishna, then is, where do you invest? Do you sense that this market, when it does rebound, is going to throw up a new set of leaders? Or do you think it's going to be the usual suspects where you will make money? Will you go back to TCS's, Reliance's and Bajaj Finance? Or would you have to rework the math completely and find a new set of horses to bet on?
My sense is that definitely you should be, currency is not the only reason to be looking to invest in export-oriented companies. But in the current environment where rupee being where it is and where oil, which is a big uncertainty, I think you will have to focus on investing in the IT and the pharma sector per se, and maybe some manufacturing companies which have a very good export base. I think for some time you will have to focus on more on the global opportunities than the local domestic consumption. I think the domestic consumption story has been done with for some time in terms of valuations of most of the companies over there, despite whatever corrections have happened, are still not exactly cheap. So the margin of safety is not there in that segment. So we would possibly avoid the domestic consumption story for the short term. That's the sense that we have. And as far as the NBFCs are concerned, I mean the corrections have been sharp and rightly so in terms of the question on liquidity, etc. But they have a business model and they fulfill an important need. And I'm sure that many of the stronger NBFCs they will be able to manage the liquidity. And wherever valuations are attractive, I think investors should be going back to investing in them.
Appreciate your time. Glad you could join us, Rakesh Arora. Now that you are with us, I can ask you a pointed question. How are you approaching this market? I mean, how does one manage risk? How does one not lose the sight of long term? Because easier said and done. When you see a shave off of 15, 20, 25%, even 50%, it just gets the fear of God back.
Yeah, so you're right, meaning market correction has been pretty steep, and it did come out of the blue, but if I look at the clues going forward, there's still a lot of uncertainty in the economic environment, both global and domestic. So I don't think there's a sharp recovery which is likely to happen, and this is a period where one needs to grind through. So probably wherever there's value coming out, one can look to invest. Like Mr. Karwa was saying, small cap is one space where things are starting to look much better. A lot of stocks have come down to low single digit Ps, and there could be an opportunity out there. The broader market might continue to fall further. There could be another 5-10% fall because large caps are still overvalued as compared to small caps, and a correction might still continue. Also, if you look at the last 4-5 years, the earnings growth was not really coming through in a meaningful way, and major part of the rally was driven by PE expansion. So a part of correction, would be, restoring of those P to normal levels, meaning all consumption stocks were trading at like 50 P plus. That's not a normal scenario, and you don't really expect too much return to be made from those kind of P levels. So some more correction is probably due out there. So one needs to be very cautious. There's no hurry to really, go and invest tomorrow. But there are pockets of value which are emerging, and one can really average out, meaning this market can really last in a bear phase for some more time, and there's enough opportunity for everyone to get in.
Okay, we noticed that you've mentioned the other bee, the other animal, bear already. But Rakesh, hold on to the thought. We're going to take a very quick break. And Jonathan, you too. When we come back, we'll try and analyze exactly that. Where are these pockets of value emerging in the market right now for us to buy?
Top of the world with Times Network. And you're watching ET Now.
He knows the market trends today and has mastered them over the last 15 years.
Bringing greed and fear and business analysis together, I think that's what day in, day out Nikun does.
He tracks the biggest business stories that impact the growth of your wealth.
He forces you to come up with a specific recommendation and not just give general answers.
His keen market sense simplifies financial jargon to make you market ready.
Market opening without Nikun Dalmia, A, is really unthinkable, and B, it will clearly be less enthusiastic.
He is most trusted by the bulls and bears alike. A name synonymous with Indian stock markets. Nikunj Dalmia, only on ET Now. She demystifies the global financial markets and their impact on India. She's the first choice of Wall Street's legends. She has a pulse on the biggest international fund managers. And she reports from the heart of the action. Tanveer Gill. Only on ET Now. She's one of India's most experienced stock market anchors. She tells you where to put your hard-earned money. She makes heads turn with her understanding of financial planning. She knows when the time is right. With her in-depth market knowledge, she sets the course for a confident financial future. Every morning, she's your guide.
Continuing our coverage on the big sell-off, and what a big sell-off it has been, not just in terms of the niggling factors like crude as well as the currency, but the fact that the markets themselves are at 4-month lows. And it was a typical sign of, you would profit take where you've made the maximum money. Look at Reliance Industries, for instance, one of the biggest gainers here today. That fell almost about 8% at the low point of the day today. TCS has been seeing consecutive selling for the last 2 days. And I don't want to even touch upon what's happening in the financials or for that matter, some of the rate sensitives like autos. They are already struggling at their 52-week lows. But a big announcement from the finance minister within the dying minutes of trade today, the fact that excise duty cut has come about for both petrol as well as diesel, and a 1 rupee per litre hit is something that's going to be borne by the OMCs. So Ajay joins in and he tracks the sector very closely to detail out the math as to, Ajay, this is going to be a big hit when we're talking about profitability for OMCs eventually.
Well, that's correct. The market fears. In fact, this news particularly broke the back of the market in the last half hour of trade today, because it gave a sense to the market fraternity that probably the government is taking a step back on one of the key reforms, which is deregulation of oil, of fuel, petrol and diesel. However, that is a point which still needs to be discussed, but making them, share about a rupee a litre did cast a shadow on the profitability of oil marketing companies, and overall sentiment got hit further, badly in today's session. Rough calculations indicate that 17% in case of HPCL to 22-23% in case of ISC. So 17 to 22% annual profit could be impacted by this move according to back of the envelope calculations. But at the same time, some of the positive points is that there are also inventory gains because crude oil prices have gone higher, and this is only a temporary measure. So taking the stocks to low single digit after the fall, the way they've come down to 4.5-5 times FY20 valuations, perhaps maybe a little more extreme. It will be interesting to see in the first hour of trade tomorrow whether the brutal treatment which the market actually treated OMCs continues in tomorrow's session as well, or does people start finding value treating this as a one-off and not a permanent step back on deregulation.
Jonathan, this question is coming your way now. Weak Indian rupee and rising bond yields are a big concern. Despite steps taken by government, do you think not much relief has been seen, because government is doing their bit to stem the rupee fall, but the selling has been so one-sided that right now whatever government is doing, that is not even acting like a band-aid?
Yeah, so our view would be the rupee, when you look at it on most valuation metrics, where it was previously reasonably overvalued, now it's gone through fair value and actually starts screening reasonably cheap. It's not screamingly cheap, but it is starting to trade on more on the cheap side. As we know in currency markets, currencies do have a habit of overextending one way or the other. So it's conceivable that we could see the rupee weakening off a bit further. Our view, however, would be, remains that probably most of the adjustment has taken place, but certainly we could see the currency weakening a little bit more, but probably not to the extent that it has done already. So on that basis, as a foreign investor, when we look at markets like India, when we look at it in dollar terms, then these markets have got considerably cheaper already.
Okay. Rakesh, wanted to get your take on this announcement by the finance minister, the fact that there is a 5 rupee per litre excess duty cut, and the fact that OMCs as well will have to bear the brunt of it. Do you think it's the right messaging for the market, for a deregulated sector? From an investment perspective, this is not really the right messaging, and that's not how the markets are reading it at all.
That was reflective in the stock prices. Obviously, there was a fear that government might tinker with the subsidy formula, given that it's an election year and given that oil prices are going so high. So stocks were already correcting. It's not that they've just corrected today. They were already in a falling mode, and today was like the last straw. While it's not a big measure, it's not a big subsidy which is being borne by OMC, but yeah, it does leave a bad taste in the mouth when everybody thought that this is done and dusted with. So this also casts a little bit shadow on the fiscal deficit. Meaning, while finance minister did point out that it's a 0.05% change because of this reduction in excise duty, but also state governments are also cutting, so maybe it's going to be more. And in any case, with GST collections falling short of the target, people were worried that they will exceed the fiscal deficit this time. And now this, and maybe MSV hike also yesterday. So maybe fiscal maths, if they have to meet, then they'll have to cut expenditure, which means tightening. So all in all, it doesn't really augur very well for growth in the country. Yeah.
It surely doesn't. But Rakesh, before in the previous segment, you were talking about as to how in the current fall, you do see value emerging in certain pockets. Highlight for us, where is it that you see some investment opportunity?
Some of the sectors were in a bear phase even before the market actually started to fall. So, pharma is one sector where, things were already beaten out of shape. And those stocks have also fallen again in this round. But fundamentals for them have improved because one, rupee depreciation is helping their cause. Number two, most of the companies have come out of the US FDA issue. And number 3, the price erosion that we are seeing in US for generic medicines seems to be abating. So all these fundamental factors plus the cheap valuations, I think pharma could be one sector which can come out really fast of this correction. So this is one big opportunity, I think. The second, probably is infra space. The stocks have corrected quite dramatically, but most of the companies are sitting on very large order books. So book to bill ratio for most of the companies are between 3 to 4 years. So this kind of visibility on revenue, these companies would be able to show profit growth, etc. And one can look at pure EPC companies, because there's some doubt about HAM projects getting financial closure, but pure EPC companies have also fallen along with these companies, and there's an opportunity, I think, there. And finally, the small caps have been totally, beaten out of shape. They are all down more than 50%.
More opinions and more thoughts going, but we're completely out of time. Pardon me for that rude interruption, but you got to wrap it there. It's been a nasty day. It's been a day of all-round selling. It's been a day when best of the bulls, they got shaken up a bit. And days like these, Aisha, when markets fall not exactly because of a global factor, just because of an incremental jump in crude or a marginal decline in crude.
With their own weight also.
Yeah. It just gets the fear of God back in the system.
Bhagwan bharose.
Exactly.
Literally, I know we are, laughing about it, but that's all that you can do, right? Just watch the ticker and pray that it stops somewhere. But that's all the time we have on this special edition of the Market Sell-Off.